Good afternoon, everybody, and welcome to today's webinar, Money Side of Business. Our guest speaker today is Cary Lavine. He has his CA and CPA designations. He has worked in public accounting, been the director of finance for two companies, funded a management consulting firm, and was the CFO at RL Solutions. Today, Cary will be sharing his insights on essential financial management tools and techniques, helping us to better identify a business's most profitable products and customers, create and monitor budgets, and use financial reports to plan for future success. We are very fortunate in having Cary with us today to guide us through this discussion. I've also provided a copy of the presentation and a few other documents in the chat for you to look over. And once the presentation is done, we will also be doing a draw for a $75 gift card for anyone who stays for the full presentation. And if you have any questions, feel free to put them in the chat, and I'll let Cary know. And with that, Cary, I'll let you take it away.
Thanks, Peter. Hi, everybody. My name is Cary Lavine, and I'm a chartered professional accountant. I'm a chartered accountant. I'm a CPA volunteer with CPA Canada's financial literacy program. There are somewhere in the neighborhood of 220,000 CPAs in Canada, so there's a lot of us, and we're in a lot of businesses, every type of business you can think of. Some of us are entrepreneurs, some of us are CFOs, some controllers, some of us have roles that actually don't relate to finance or accounting as much, but there are a lot of CPAs out there in Canada helping business get done. This is a 60-minute session. It might run a little bit over. I know it's being recorded, so if you have to leave right on the dot at 60 minutes, then you can always come back and look at things. We're going to be looking at basic tools and methods of financial management, including using budgets and cash management. This is just one of many of CPA Canada's financial literacy workshops. There are a lot of different ones specifically geared towards entrepreneurs. So my background is I am an entrepreneur. I'm a CPA, but I'm an entrepreneur, and I have built a number of companies. I retired from the corporate world 3 years ago, but I was building companies over the course of 30 years or thereabouts. The last one, and the company I was with the longest, was a company called RL Solutions. We were a software company. We made software for hospitals. I joined the company when we were just 5 people. I was one of the owners. And I'm not a founder, but I was there very early days. And when we sold the company to private equity about 6 years ago, we were 220 people. I stayed on for another 3 years. And then when I left the company, we were close to 1,400 people through several acquisitions that we made under the private equity guidance. So I've seen the company grow from 5 people to 1,400 people and be acquired by private equity. I'm going to try and avoid and I'll refer to some of my experience in terms of what we went through as a company in terms of when I'm talking through different aspects of this presentation. I'm going to try and avoid lingo. There will be some. If you have questions, speak up. It's fine to put a question in the chat as we go, and I'll try and address it. There aren't dumb questions. And we'll try and save a little more time at the end if there's any questions. So one thing I was going to ask right off the bat is, can we take just a minute here for those who are on the line? If you are an entrepreneur, business owner, if you could maybe put a little note in the chat to say what type of business you have, I might be able to speak a little bit more to our collective experience as I give the presentation. So if you could put a note in the chat to say what type of business you are creating or have created or are running, that would be great. I'll just give that a minute. Okay, I see Michelle put in there educational consulting services based. That's great. Thank you, Michelle. Anybody else who can put something else in there about the type of things you're doing now, or maybe what you've done in the past? So I will say this presentation will be more interesting if we have more participation. So, okay, fashion and traditional crafts. Okay, thank you. Stacy. Okay, I'm going to move on. We're on to the next slide now. So, common questions business owners ask, and we're going to be talking about these. And I see a stained glass business from Angela. Thank you, Angela. So, some common questions that business owners ask. What you get is things like what is financial management? What tools can help operate my business? How do I know if a product or a customer is profitable? What are my most profitable customers or my most profitable products? Why do I need a budget? How do I create and use a budget? What reports do I need? And how do I sort of plan for the future? Where's my business heading? One of the most basic things that every business owner is thinking about is where's the cash coming from and where's it going to? If you have employees, can you pay them? If you've got expenses, can you pay those expenses? Do you have the cash flow to cover that? And so the thing about being smart with your business is knowing answers to these things. And the way I like to think of it is that information is power. And when you're running a business, having the answers to these types of questions and knowing how to approach them will empower you, will have you be more powerful and successful as a business. A lot of businesses fail. They never reach their full potential. Many businesses don't keep their books up to date or understand their numbers. Many don't have budgets or forecasts. There's often a connection between the businesses that don't understand their numbers and don't have things like budgets and the businesses that fail. I will speak a little bit about this as we go, but just as two contrasting examples of businesses, I shared a little bit about the software company that I built over the course of 21 years with some other dedicated business owners. My sister started a food truck business. I think it was about 4 or 5 years ago now, and her business only lasted about a year. She didn't actually have much of a business plan, and she didn't have much in terms of understanding her numbers. And it's possible if she'd spent more time on those aspects of the business that her business would have been successful. So, again, information's power, and will empower you in your business and understanding what's going on. Speaking a little bit more about the business that I was part of for 21 years, when I joined the company, we were 5 people. We were barely able to make our rent and pay our 2 employees every month. 3 of us were owners, and we weren't getting paid, period. But we did have 2 employees who were on payroll, and it was tough. And it was frankly also kind of scary at times, thinking, are we going to have the cash this month to pay payroll? We sold software to hospitals, and all our focus, a lot of the focus was on making the next sale. It was always about making the next sale. Who are we going to sell to? What does our sales pipeline look like? And those are obviously really important, because if you're not thinking about your sales pipeline, or your marketing or bringing in the next customer, you don't have much of a future unless you're very lucky. Having said that, if you don't know how you're going to collect the money and then turn that into cash flow that you can then pay your employees and pay for your supplies and your people and stuff like that, that can be a challenge. In our case, the people that were running the business, the founder of the business before I joined, was very much focused on getting the next sale. And when I joined the company, I could see that there was a real problem. And we sold to hospitals, so we were business to business, and we had to collect our receivables. And there wasn't a focus on collecting receivables, but by understanding the numbers, I was immediately able to say, okay, well, we actually have a resource here. We have money we're owed. Let's go collect it. And so one of the first things I did when I joined the company is I started actually reaching out to our customers saying, I need you to pay. So that gives you an idea of, looking at your numbers, you can learn stuff. You'd think that'd be self-evident, but I assure you that the founder of the business, who's a really smart individual, just wasn't focused on that. So that's a risk for any one of us in a business. What is financial management? So tracking performance, analyzing results, and taking action. It's not a curiosity. It's actually a key piece of what we're doing when we run a business. Focusing on profitability and other business goals. as a business, you're probably focused on. I mean, for example, if I look at who spoke up and what types of businesses they had, fashion and traditional craft, educational consulting, you're going to be focused on delivering a high quality service to your clients. Or in the case of fashion and traditional crafts, you want to make sure that what you're selling is of good quality. And you might be thinking about where you're getting your products, or if you're creating them yourselves, you might be thinking about how you present them. But there's the other part of the business which there's no overlooking, because at some point it'll really bite you if you're overlooking it, which are the numbers. Ultimately, unless we're running not-for-profit businesses, you're going to be, and most of us aren't running not-for-profits. I assume most of us are running for-profit businesses. How do you know if you're successful? Well, it's a bit like a scorecard, your numbers, your financials. And even if it's a not-for-profit, you still need to understand the financials, or else, everything you're trying to create can go out the window very quickly if you're not meeting your basic financial needs. So we're going to talk about basic tools of financial management, the financial statements, what is a budget and how to use it, how is that different from a forecast, and we'll talk a little bit about industry benchmarks. So what is financial management? Again, there's sort of a circle you go through in financial management. We talk about timely reporting. So at the end of a month, or the end of a quarter, certainly at the end of a year, you report on, you figure out, how did I do financially? And that's going to be your financial statements, your income statement, your balance sheet, and so on. You do budgeting periodically too, to sort of say, well, how am I doing relative to my budget? I came up with a budget. A budget is like a target. Once a year, or maybe more than once a year, I create a budget that says, this is where I'm going over the next 12 months. This is what I want to achieve. And then when you produce your financial statements, you look at that and you say, how did I do compared to my budget? Cash analysis is a slightly different flavor of it's part of financial reporting. It's looking to see at things, for example, like where did your cash come from? Where did it go to? It might be looking at the profitability of a specific customer or a specific product. You've got you project and do trend analysis. That's where you kind of look at your numbers and say, well, how am I doing now? If I sort of project these numbers into the future, what do they tell me? And you can sort of see trends. And then you can dig into things like I was already saying, product or customer analysis. How are some customers more profitable than others? Do I have 2 customers that are 80% of my business, and a whole bunch of little tiny customers that are the other 20%? Are some more profitable than others? These are the types of things you look at to understand your business better. And it all circles back to timely reporting. You kind of go through a cycle where every quarter or every year, or depending on how you do it, produce financial statements, you look at budgets, you do some analysis. One of the things, you'll see a lot of references in this presentation to product. So for example, product analysis, that could be just, that term is used generically. It could be service. And whether you've got a consulting firm, or whether you're providing a service or a product, either way you can do the same type of analysis. And I'll give you some examples of that as we go. Okay, so let's take a look at the things from a product perspective first, or some of the questions you might ask when you're looking at your products. Sorry, I just want to make sure we're on the right slide here. Yeah. So how do you determine if a product is profitable? And this is a key question. If you sell a lot of products, you may have products that are making money. You may have products that don't make much money. They just kind of break even. And you may have products that you lose money on. There are sometimes reasons to have products to lose money on. We sometimes will call those a loss leader. If they kind of draw people into the store, or if you might get your customers hooked, and then they buy the stuff that's more profitable. If you have an internet business of some sort, often the internet businesses provide a free service of some sort, a free app. They lose money on that because you can't make money on free. However, once they get you in, they can make money on things that they are profitable with. So there are sometimes reasons to have products or services that aren't profitable, but if you don't on balance have a mix of things that do make you money, then you're not going to succeed. And understanding the difference between the two and how much money you're making from each or losing is really important. So what you would do is you would list all the products, and then you look at something called gross sales for each product. You look at something called cost of goods sold. You look at gross profit, and then you might sort your products by their gross profit. So what is gross sales? Gross sales are your the total sales you get from a given product. So if your sales in a month, for example, were $10,000 and you have 5 products, your average sale per product would be $2,000. But it never works out that way. Some products, you might have one product that's got $5,000 worth of sales, and the other 4 products are, adding up to the difference. So you figure out what your gross sales per product is. So in this case, it's going to be, it's going to add up to 10,000. Then you look at what your cost of goods sold is for each product. And again, I'm using the word product interchangeably for service. You can think of it either way. If you were, for example, running a craft store or an online craft business where you're selling certain crafts or arts and things like that, then you might look to see, well, which items did I sell this month? How much were my total sales? And then if you bought those things, you probably know how much you paid for them. And you're going to want to look to see what was the cost of those items that you sold. By the way, cost of goods sold, when we talk about that, we're talking specifically about the variable cost associated with a given item. So if you sell, let's say you have a toy store and you sell the game Monopoly. When you're looking at cost of goods sold, it's what did you pay for each of those Monopoly games. You wouldn't include things like rent. You wouldn't include labor, nothing like that, because cost of goods sold is literally the variable cost. It varies directly with the number of units you sell. So you look at your cost of goods sold associated with selling Monopoly games, and you then can look at if you sold 20 games, you know what your cost is per game, you know what your gross profit is. Your gross sales minus your cost of goods sold equals your gross profit. And we sometimes express that as a dollar value. So for example, if you sold 5 games at $50 each, for argument's sake, that's $250 of gross sales. If each of those games cost $30, that means your cost of goods sold is going to be 30 times 5 is 150. And if your gross sales of $250 minus your cost of goods sold of $150 leaves you a gross profit of $100. And 100 over I want to make sure I'm getting my numbers right. 250 minus 150 leaves 100. So your gross profit's 100, and your gross margin, we sometimes call it. We can look at this, and this is your gross profit divided by your sales equals gross margin. We're going to talk about that on the next slide. But what you can do then is you can say for all your sales of the game of Monopoly, you made $100 you had gross profit of $100. And you would look at gross profit for each of your products. And by the way, this can sound like a difficult task to do. If you've got a lot of products, it might be hard to do. So you can also do it by product category. You can also do it for services. And in the case of my software company, what we did is we actually sold professional services as part of our offering. And I knew what my revenue was because when I billed based on a certain item code. So I knew what I was selling. I knew I was selling consulting. And I knew my total revenue from consulting, my total gross sales for consulting. And I knew what my service team, my labor team, I knew what the cost of their salary and things like that were. So I could literally look at their cost, in that case, the cost of goods sold for my consulting team compared to my sales from selling their consulting. The difference is gross profit. And I could see if I was making money or losing money. So let's go to the next slide. So here's another look at product analysis. How to determine how profitable a product is. So if you take your gross profit, in the example I gave before, where I had $100 of gross profit from selling this game, my gross sales were $250. That makes a gross profit of 40%. 100 over 250 is 40%. And for some products, I might have a 60% gross profit percent. For other products, I might have break even, like 0% or negative. And what you want to do is look at that percent is another way to understanding how you're doing with your different products. And again, you can, in this slide, you can sort your products by gross profit. You can also sort them by gross margin. When I think about gross margin, in the example I gave there, my gross margin was 40%. It was 100 profit divided by 250 in gross sales. That gives me 40%. I kind of think of it as how hard I'm working to earn each dollar. The higher the gross profit percent is, the less hard you're working. If you have $10,000 worth of sales of a given service, let's say, and your gross profit is only $500, that means you did make $500, but you had to sell $10,000 worth of a service or product to get that $500. Versus if you have another group of products or services where you sell 10,000 and your gross profit is 50% or 5,000, you're not working as hard to make that profit. And so gross margin kind of gives us a sense of how hard we're working to earn things. And also it might be a little bit about turnover, because if you're selling tons and tons of stuff to bring in a reasonably small amount of gross margin, maybe you want to focus on different products that have a higher gross margin percent. So this also speaks to different types of businesses. If you think about a dollar store, it's a high volume, low margin business, right? They sell a lot of stuff, and they may not make a lot of money on each item, but because they sell a lot of it, they're able to have a successful business. Now, if you compare that, for example, to a Ferrari dealership, a car dealership, a high-end car Ferrari, they don't sell many of those cars, but the profit's very high on each of those cars. So it's just, both business models can be successful, but they're really two different ways of they're two different ways of having a successful business. High volume, low margin, low volume, high margin. Either can get you the same profit, but they're going to look very different. And it really is helpful to understand what type of business you're targeting. Another way to think about it is, are you selling a really high quality, high end product? In which case you better have a decent gross margin. Or are you selling kind of like, like a dollar store? You're selling a lot of stuff. You don't expect to make a lot of money from each item, but it adds up to enough to have a successful business. Now, another question you might ask yourself when you're looking at these types of numbers is, do you want to get rid of certain products that are low margin, or maybe you're even losing money on? You can do the same thing with services. When we looked at our software company, we actually did determine that certain services were not very profitable, and it had us change how we offered those services. I'll say a little bit more about that when we get to it. Again, more on product analysis. Once you know how profitable each product is, you can do a number of things. You might want to compare your pricing to the market. And in these days, obviously, a lot of that you're going to look online and see what other people are selling their stuff for. But if you've got a store and there's another store down the street or another store of similar in the next town over, you might want to see what price are you selling your items at compared to your competitors online, if you're selling online, or your competitors in the next town or something like that. If you have flexibility with pricing, you may look to enhance the profitability by increasing your pricing a little bit. Another approach, obviously, is reducing your costs, and you can look at, again, we're talking about gross profit, so this has to do with your sales minus the variable costs associated with those sales. So that's the cost of the game I gave an example earlier, or in the cost of the services you delivered. You might want to see, can you deliver those services more efficiently so you're putting less labor into each sale, for example. You may want to focus your marketing or what you're trying to sell on the more profitable products so that you can sell more of that, because some people get surprises when they do this type of analysis. They thought a certain product or product group was very profitable, and they put their marketing into that because they thought that's what people wanted, maybe. When they do this type of analysis, they may actually learn, oh, wow, maybe I'm emphasizing the wrong product. I want to emphasize product B instead of product A because it's more profitable. And then some choices are harder to make, or maybe they're easy to make, which is you may realize there's some things you're giving away or you're charging too little for, and you just get rid of those because ultimately you want your products to be profitable, and unless it's deliberate loss leader, that's not something you want. I mentioned my company. We had professional services we sold, or you can call it consulting, with our software. At some point, we realized they weren't very profitable, and we were doing a lot of it. Now, as a business, we were still very profitable because we made a lot of money on our software, and we charged recurring annual fees, our support and maintenance, and we made a ton of money on that. But our professional services, we were not making money on. And so we in doing the analysis, we addressed it. And I will say, because we were a good sized business by then, we were over 200 employees. It took time. It took a couple of years to really transition things to more of a profitable consulting business. But what we did is we started delivering more fixed fee contracts where we said this is the amount we're charging, and it's actually not by hour. And one of the things we did with that is we actually limited the number of hours we deliver for that fixed fee contract. So we knew that we weren't going to lose money because we weren't going to go over those hours. And we did something where when we were selling software, we also tightened our scope of work. So it wasn't open-ended. So a client couldn't have us do anything and everything they wanted. It was very specific. This is what we're doing. And we had a box around that. And we could always go back to the client and say, hey, you know what? It looks like you want something that's not in this box we have. But we can sell you that service. It's just incremental money. And we had to get better at asking for more money. Our clients liked us and they liked the service and the product we offered, but we weren't so good at asking for more money when it made sense. And so that was part of the reason why we were losing money on our consulting, and we changed that equation and got good at that. We actually trained our staff on how to get better at asking for or selling more, asking for more money. And I said a little bit about this in terms of looking at pricing. Pricing can be a secret power. If you're really good at your pricing, it can be something that distinguishes your business from a lot of other businesses. Again, you can gain knowledge by looking online, looking at your competitors. In our case, we were running a consulting business and selling software, and we actually found that we had a fair bit of flexibility in charging more for our software than we thought. And we also found we had a fair bit of flexibility in terms of what we were able to charge for our ongoing annual support and maintenance, because clients didn't really look at that very carefully when they bought the software from us. They knew they had to buy it long term, but somehow they only looked at the upfront price tag. So we realized we had a lot more flexibility in terms of what we could charge annually once they were hooked on our product. So a key message here is know your numbers and be intentional in what you're doing. I said earlier that understanding numbers, that information is power, and it can empower you to be smart about your business. Not paying attention to numbers means that you really don't have your hands on the dial. It's almost like driving a car without looking at the speed you're going, without knowing whether you're running out of gas. Looking at your numbers can provide you with a lot of smarts to be smart about your business, and then to be intentional about what you're doing from a financial perspective. More on that theme to follow. So then you can do a similar type of analysis with customers. You can look at how profitable is one customer compared to another. One of the things about our business is, by the way, and this is true for a lot of businesses, the 80-20 rule applied, where 80% of our revenue came from 20% of our customers. So there's a high concentration. We had a few customers that accounted for a big chunk of our revenue. And the 80-20 rule can also apply to what you sell, your products or your services. It may be that 80% of your revenue comes from 20% of the services or the products you sell. I'd be surprised if it's really balanced across a bunch of products. It often is very much weighted towards a few customers or a few products. And so it's really important to understand what's going on with those few customers or few products, because if that's what you're selling the most of or who you're selling the most to, obviously you want to be smart about making money on those ones, and you want to be smart about taking care of those customers. So back to this, you can take your customers and do the same type of analysis. Now, if you're using modern accounting systems where you're billing, you're doing stuff and you're billing in your system to a given customer or against a given product, you're using product codes, you know exactly how many of each product you sold or exactly to which customers you sold, then doing this type of analysis isn't hard, where you can see what are your sales by product, what are your sales to each customer. You can do other types of analysis where you can look at what's your typical shopping cart per customer. You can look at your gross profits and your gross margin by customer if you understand the cost. Again, like this, some of this comes down to having the right accounting system, because if you know your costs by product, you can then look at also your cost by customer because you've sold certain products to those customers. And then you can look to see what your gross profit or gross margin is on a customer basis. You can sort them by gross profit or gross margin, and you can make some of the same decisions. And I will say that doing this type of analysis where you're looking at customer-based profitability is a bit different if you're selling business to business versus selling to lots of consumer product. Because if you're doing business to business, then you may have concentration in big customers. If you're doing to a lot of individual consumers, you may not have that type of concentration. A lot of my comments earlier relate to having sort of more business to business. But even within selling to consumers, you may have a class of consumers, a group of consumers, or different types of groups of consumers. And it may be that certain groups you look at differently than others, and you can do this type of analysis that way. Certain types of customers may buy your more expensive products, that type of thing. So it's good to understand this type of thing, and then you can make decisions based on that. By the way, my software company, we had somewhere in the neighborhood of 700 or 800 customers, and they were repeat. They came back and bought our annual support and maintenance and other things on a yearly basis, for example. So we really could kind of look to see what was our sales by customer. And then when it came to our services, as I said, we also offered professional services. We actually used timesheet type of data where our staff who provided the professional services recorded their time, and they allocated that time in the accounting system to customers. So we could literally see how much time was put into this customer versus this customer, and it really allowed us to understand the profitability by customer. I've already said this, you can sort your customers by profit or by gross margin. And then again, just like you might want to support your you may want to focus your marketing efforts on the more profitable products, you probably want to put your focus into the more profitable customer or customer type. If you segregate your customers by different types, and you can see that this type of customer is more profitable, customer category A is more profitable than customer category B or C, then you may want to say to yours, and doing this type of analysis will help with this, then you say, okay, how do I get more customer A? How do I get more types of customers like customer A rather than customer C that's not very profitable? It's hard to do that type of analysis. It's hard to know exactly where to focus your marketing dollars to maximize profit if you haven't sort of done some math, if you haven't done that math to understand that. And actually, I will tell you that we dropped some customers that weren't profitable. They were just too demanding, and it's tough to do that because they're the demanding customers, and they're the ones you're always paying attention to. So it's hard to it's like a relationship. It's hard to actually say goodbye to the person on the other side of that relationship. But in a business setting, it's got to be win-win. Especially if you're doing business to business and you've got customers coming back, but even if it's retail, it's got to be a win-win relationship. And if you've got customers who aren't profitable, they're being too demanding, for example, then it's not a win-win relationship. You're losing, they're winning because they're getting way more service than, for example, for the dollar they're paying. One approach to that is just to say, I'm sorry, we don't want to service you anymore, or to stop selling to those type of people. Another approach is just to raise the price to those customers, if assuming there's a reason why they cost too much. You can just decide the price has to be higher for what they're buying, and then they may decide to go somewhere else where they can get a deal. But you haven't lost anything because you were losing money on them anyway. You're actually better off without them. We found out in our case that our smaller customers often demanded as much as our medium-sized customers. So we really had to change the price to some of our smaller customers to make them more profitable, or to put scope around what we offered them so that they couldn't just ask for anything and everything. We also developed more self-learning tools so that we weren't actually literally having to do the labor to help them. They could look online. We increased prices. And we actually let them know they were too demanding with the general idea that it has to be a win-win relationship. So when we told them they were too demanding, we could say, hey, we're losing money on you as a customer. We want to keep you as a customer, but we can't continue to do it the way we're doing it because it's not working out. In other businesses, you can get creative in other ways to find ways to structure things. One of my previous businesses before this software business, I ran a boat maintenance business, and this was a business where all my customers came over to the yacht club on the weekend, and they all wanted to enjoy their boats on the weekend. So they all wanted their boats cleaned on a Friday because they were all coming over at the end of Friday or on the Saturday or Sunday, and they wanted their boat to be clean. And seagulls came along and pooped on their boats, and so if they got it cleaned on Monday, they'd have more of that on their boat when they got there on Saturday to use it. And what I did to sort of address the profitability and some of the challenges I had with costs was I actually changed the prices. When I started, the price was the same regardless of which day I cleaned your boat. So I changed it. So I charged a lot more for Friday cleaning than I did for example, Wednesday or Monday cleaning. And that was a way to kind of find a balance for things that work from a profitability and a resource planning perspective. Okay, so let's move on now. So those I was speaking about how to understand the profitability of customers or products. Those are important analyses to do, especially if you're thinking maybe some are more profitable than others. If you're thinking, how do I turn some around? Now let's talk about financial statements. I spoke earlier about that cycle where you measure your results, you compare them against your budget, and then you do analysis, and then you repeat. And that's a regular thing you do. You can do it. In our case, when we got to a certain level of sophistication, we were producing monthly financial statements because we were big enough, and we also really wanted to know our numbers because we were really focused on hitting certain goals. Those goals were documented in our budget. We knew how much profit we wanted, and some months were bigger months than other months, and we knew that. So our budget was a month by month budget. Some people will do annual. But let's talk about the financial statements, which is a key measure of success for most businesses. I'm going to say for pretty much all businesses, even not for profits. They have to have a reasonable level of success with their financial statements, with their numbers, because if they don't, they're gonna stop being able to do what they do as a not-for-profit. And then, of course, as a for-profit business, we all want to take home a reasonable paycheck. We all want to be paid well. We want to grow our businesses. So these are really important benchmarks of how you're doing. So the three standard statements are, if you look at the left side of the screen there, is a profit and loss statement. We sometimes call that, in fact, I call it an income statement typically. Or sometimes it's called a P&L, which is short for profit and loss. There's a balance sheet and a cash flow statement. Every business uses these three statements. A profit and loss statement is for a period of time. So you'll say, for example, for the first quarter of the year, this was my profit. A balance sheet is like a snapshot in time of the assets and liabilities you have. So at the end of March, this is what my assets and these are what my liabilities look like. That's a balance sheet. It's a point in time, say the end of March. Profit and loss statement or income statements for a period of time. That might be for the first quarter, January to March. And a cash flow statement is also a period of time. So that would be how much cash did I bring in and from where? How much cash did I disperse and to who over a period of time? So that would be also, say, January to March if we're looking at Q1. Now, you may have a fiscal year end that's different than December 31st, but I'm going to speak in a calendar year basis for our purposes of our discussion. You may also look at profitability. So those are the primary financial statements. In the middle of the screen, what it's talking about is selected profitability ratios. That's what we were just talking about, things like the profitability of a given customer or product or service. And then there's the other things where you've got budgets and forecasts, and those are the types of things where you would compare your financial statements, for example, or your ratios against what you were targeting. Budgets and forecasting. A lot of businesses don't do this, and it's a lost opportunity because if you don't have a goal, how do you know what you're aiming for? So I know we all have to produce financial statements at the end of the year for taxes. If you've been in business for any length of time, you know this. You have to produce them. And you could just do it just strictly for your taxes, but then it's really a missed opportunity. You really want to be looking at your financial results more regularly than that. And then with that is at the beginning of the year, what are you aiming for? If you're not aiming for something, if you don't have a goal in mind, this is what your budget's used for. So that's really important. Okay, so let's move on to an example of what things look like. Here's a profit margin analysis. Actually, actually, this is bothering me a little bit. Oh, okay. Sorry, I just had to jump ahead there. It's funny, my slides seem like they're out of order. I apologize for this. This is an example of measuring profitability where gross margin, monthly gross sales, 20,000 minus cost of goods sold, 9,000, gross profit of 11,000. This is 55% gross margin. I apologize. I'm not sure how my slides got out of order here. This is, again, looking at profitability, which is what I was talking about earlier. I'm not going to dwell on this slide. We'll keep moving past this. This is now looking at, this is now taking our profitability. So actually, if I back up a couple slides, we're now talking about the three primary financial statements, and this is now looking at our profit and loss. So this is the first part of a profit and loss statement. And what this looks at is your sales, that's always a top line, minus your cost of goods sold, gives us our gross profit. I just realized I was interpreting slides incorrectly. They are in the right order. So this is what we're looking at is the different parts of an income statement. So in this case, we had sales, and then cost of goods sold, and we had gross profit. If we look at the next slide, this also shows us what our profit margin is. So we have, our operating profit is this sort of the next section of a financial statement. So you start again with gross sales, you have minus cost of goods sold, then you have minus operating expenses, and then you've got your operating profit. Now, cost of goods sold is different from operating expenses. As I said before, cost of goods sold are things where there's a direct relationship with the items you're selling. If you're selling games, for example, or if you're selling crafts, your cost of goods sold are the cost to make the crafts or the cost to buy those games. It would not include rent and things like that. But your operating expenses would include things like rent and marketing expense and stuff like that. So when you take your gross sales minus your cost of goods sold minus your operating expenses, things like rent and marketing expense, general admin, you're left with an operating profit. And you can see in this case, there's an operating margin of 30%. The higher the ratio, the better. And you can use benchmarks to look at that. Then what you do is you want to get to what your net profit is at the bottom. And this is now taking, again, starting the same place, gross sales minus cost of goods sold minus operating expenses minus taxes and interest. They're kind of like the last piece. This business had a $4,000 profit on $20,000 worth of sales. That's a net profit of 20%. So that's what your income statement is. It's your sales minus all your expenses, gives what your profit was at the bottom there. Now, a cash flow statement is a little bit different. We're going to talk about that a little bit. Now here, cash flow, you're looking at things like, or these are some ratios. You might look at things like return on assets. Sorry, I'm just jumping ahead to the next slide here. My apologies. You may look at something like a cash flow statement. You can see what your, you can look at things like net profit divided by total assets. You may look at return on equity, which is net profit divided by owner's equity. And these are ways of comparing different businesses. So for example, whether you've got a company that sells toys or a company that sells crafts or another company that sells services, they use these types of ratios looking at the financial statements to understand the differences between different businesses. I'm just going to jump ahead here because again, I think that it's funny. I don't actually see, I'm looking for the slides on balance sheet. Okay, so let's now talk about budgeting. A budget is the type of thing we often compare against an income statement or a P&L. And the reason why you need a budget, as I've already kind of alluded to, is to clarify where the business is heading and to understand things like what's happening, where your expenses are higher or lower than you think, where is your revenue higher or lower. What the normal process in the business, the process we went through in my company is we looked at our income statement on a monthly basis compared to our budget, And we really wanted to see what were our sales, what were our costs, and what was the bottom line compared to budget. And we prepared a budget once a year. And this gives an example of what a budget analysis might look like for a P&L. And you can look at it, you can do it again this monthly or annually or even quarterly. So in this case, what we did is, here's an example of one where the sales are $45,000. The net profit was, the actual results, the net profit was $7,350. The budget had lower, it had, you can see that the budget is different than the actual, and it almost always will be, because you put your budget together without knowing what's going to happen, and then you can look at variances and see what you can learn from that. And in this case, the sales were higher, the costs were lower. The costs were a little bit higher as well, but in the end, the net profit was higher than the net profit was higher than budget. So this is a successful picture. You can also do a similar type of thing where you look at your balance sheet. So here's a balance sheet, and I said a balance sheet is the type of thing where you're looking at a snapshot in time of what do I have in terms of assets and liabilities. So here's an example of a balance sheet where it's compared against budget. This business has cash, accounts receivable, inventory, and equipment. For example, using the craft business as an example, or a toy store as an example, inventory might be the crafts or the toys you have in the shop or that you have in your warehouse. And equipment would be the things you might use to produce those toys, or maybe it's your computer and other equipment you have to run your business. At any rate, in this case, at this point in time, the company had $2,000 in extra cash in the bank compared to plan. So that's just, again, something you can do periodically to see how you compare, and this is very important. So then there's developing your budget. How do you do that? What I tended to do most of was actually use the results from the prior year to educate myself on what might be possible this year. I might look at industry benchmarks, but I kind of had a more of a sense of what I did in prior years. Now, if you're starting a business from scratch, you may not know. So you have to do some research to figure out, well, what's realistic that I might be able to sell this year? But if you have experience from prior years, that's a really good place to start in terms of understanding what might go into this next year's budget. You would probably want to rely on the expertise of other people if there's other people you can actually talk to. My company, what we would do is we kind of would start with what happened the prior year, and then we would say, well, what are our key initiatives this year? What are some of the key things we want to do? Do we have a big marketing campaign planned? Do we plan to hire staff? And if so, how many? And then based on that, we would change our budget to work with those assumptions. Well, if we're going to do a big marketing campaign, we expect more sales. If we're going to hire more people, we expect more costs. Obviously, hiring more people depends on us selling more, because we can't afford the people if we're not going to sell more. And that's the type of thing we would do when we're putting our budget together. So again, we talked about, way you would use a budget is you would look at the budget variances, and you don't want to wait till the end of the year to do that. You want to do that monthly or quarterly, ideally. You want to look for unexpected trends and understand the differences. And what some people, and myself included, find very helpful, especially people who aren't very numbers oriented, to understand a budget, is they will put things in graphical terms. Like if you can show a sales line, for example, on a graph, your actual sales compared to your budgeted sales, that's very revealing, and it can give the non-numbers person a little more understanding. And if that's not you, if you're the type of person who's not so good with numbers, it's good to have an accountant on your team or someone who can help you with that, so you can understand that as well. Now, I will say, also with budget variances, types of things that it can tell you when you're looking to see the variances from budgets is you can look at where is your marketing working. What's the delay between putting in sales efforts and actually paying off? And when you look at the variances, it can make you smarter, so you understand your business better than you would have understood it otherwise. If you don't have a budget, and if you don't look at, or you have a budget but you don't look at the variances, it's really hard to kind of understand what's going on. And you want to be able to understand that and then use that to like refine your thinking about the future. But you also want to use it to refine how you deliver your product or service. And you want to be able to learn from it so you can educate your staff too, so they know what to do and how to do it so that they can be more successful at driving more sales or more profitable sales. One of the big failures of many businesses that fail is not managing the cash flow. And that's where you want to really use your cash flow statement to understand what's going on with your business. It's the primary tool to understand where your cash is going. You can think as your income statement or your P&L and your cash flow statement is they're similar, but they're not the same. A cash flow statement and a profit and loss statement are different because a profit and loss has timing differences where you buy equipment, you don't expense all that equipment in the year, you expense it over time, where on the income statement you only expense the depreciation, for example, a portion of the equipment. Whereas on a cash flow statement, if you bought a new, let's say a 3D printer, on a cash flow statement, that whole 3D printer is cash out the door on the day you bought it, unless you financed it. And both of those pieces will be in your cash flow statement, the financing and the purchase price. But you can use cash flow statement as a really important thing to understand the differences between, where your cash is going and where is it coming in. You can look at it to sort of say, well, maybe I need to stretch payments to vendors or collect my receivables sooner, my accounts receivable. I talked about that at the beginning when I joined the company. This is the type of thing where, again, you can look at trend analysis with cash flow and you can kind of say, okay, how much cash should I expect to have in my budget at the end of each month and how much should I actually have? And in this case here, it's not a good trend. I expected to have $51,000 at the end of June. I actually only have $23,000. So this is the type of thing where you just have a budget and you say, what do I expect to have at the end of every month? And then when it's different from that, as it will invariably be, it will be different. It may be higher, maybe lower. It may be higher some months, lower other months. Whatever it is, you'll learn from it by doing that type of analysis and actually being able to take a look at this. Forecasting is a little different from a budget. A budget is the type of thing where you set your goals for the year. This is what I want to achieve from a financial perspective. This is what I want my cash to be at the end of the year or at the end of each quarter. This is what I want my profit to be for the period or for the year. A forecast is kind of like it can be as little as a year. It can be as much as 2 or 3 years. But what you're doing is at any point in time you're revising your estimates of what you think is likely to happen. A budget, you kind of lock in and say, this is my goal. I want to achieve this year. And a budget doesn't change for your year. But a forecast, you're updating constantly with revised assumptions. So, and financial statements are a piece of understanding what's changing, and you would update your forecast based on what has changed. So if you realize a marketing campaign you had is blowing the numbers out of the water and is going really well, your budget hasn't changed. You're just going to beat your budget. You're going to do better than you thought probably. But you will adjust your forecast because you realize suddenly now my expectations are higher. It's more realistic that I'm going to have a lot more cash at the end of the year than I thought, and therefore I can change what I'm going to do. I still have my budget locked in, and I'm going to compare against that at the end of the year or quarterly or whatever it is. But forecasting, you know that whatever you originally put in your budget is not realistic. You're going to do better than that, or maybe you're going to do worse. But either way, you would update your forecast based on sort of the current situation and what you really think is going to happen. A little more on forecasting. You can use sort of trends, and you can, it's the type of thing like a budget. When you put together a budget, by the way, it's a type of forecast, except the budget you lock in. When you put together a forecast, you're updating it periodically. You're not waiting until the end of the year to update it. And also like the budget or like differentials from your results, actual results versus budget, you look at your forecast and you say, what is changing in this? Why do I think things are changing? And then you change your plans based on that. Another thing in the business you may look at is, we talked about this a little bit, is trends and looking at specific numbers. In this case, we're looking at the trends analysis of gross sales. and the budget called for sales to be relatively flat. That's the darker line in this graph. But actuals, in this case, I mean, this is a great story, right? The actual results are way higher. And starting in April or starting in May, we jumped way ahead of what we thought was going to happen in our original budget. And so this illustrates a couple things. One is trying to understand what's actually happening in my business, and looking at the numbers can be very helpful. Another is that looking at them graphically can also be very revealing and show a little more information than if you just look at numbers on a chart like we see on the left. And then finally, it's like, what can I learn from this? Oh, well, I'm doing something right. The marketing campaign is working. You can actually say how well it's working, and that's the type of thing you can then decide, okay, based on that, what am I going to do next? By the way, actually, on this note, I want to mention one other thing. Having sales take off like this can be great, but it can also be a problem. It's great because it can enhance income, and it's a sign that your business is successful. But it can actually lead to cash shortages, because if you're selling faster than you can pay your you need to, let's say, for example, you're not collecting your receivables right away. It can actually lead to some cash shortages. It certainly can lead to increased stress. So whatever the results are, and you'll learn something from them regardless if you compare them against your budget. And there's always some good news and bad news. Hopefully there's always good news, but sometimes there's bad news with that. And here's another trend analysis. This is looking at accounts receivable. In this case, I expected, for example, in this case here, a budget, we expected accounts receivable to be pretty flat, 80,000 at the end of every month. It turns out actually it's crept up above that. It's, by the end of the year, or by the end of June, it's 92,000 versus what I thought it'd be 80,000. So this is an example where maybe my sales were higher than I expected, but my receivables are higher too. It means I'm not collecting my money as fast as I thought. And this is one of those double-sided coins where the good news is my sales might be higher. The bad news is my receivables are higher and I'm not collecting my money fast enough. I may run into a cash crunch. So this is where looking at different pieces of the business, not just your income statement or P&L, but also your balance sheet, can be very helpful to understand what's going on in the business. Okay. So there's some resources that I believe Peter distributed in the chat to this, and I believe he may be sending them out afterwards. There's a glossary of terms. Some of the terms I used are in there, and some additional ones as well. There's an implementation checklist, which can help you see some of the pieces to work on. There's some links here you can try that'll give you some more information, and where you can do research. And I just want to open it up to questions now. Do I have any questions? You can put them in the chat and I'll try and answer them. I don't see any questions, Peter, so I guess it's over to you. Oh, I think you're on mute.
Yeah, so I guess it's over to me now. So Cary, thank you so much for doing this. Very insightful, and we will send off the emails as well. Angela, do you have a question? Okay, so she's asking for cost of goods sold. She teaches classes. How do you?
Oh, okay.
So yeah, do I need to itemize the materials used in the classes?
I would say so. A few things about that. One is when you run like a service business, and I would classify. I would classify teaching as a type of service. Your main cost is labor. Probably that won't be all of it, but for example, if you pay yourself, or if you have, if you might even think of, and it depends how big your business is. If you had 5 teachers working for you and you're paying them a salary each, or you're paying them by the hour, then their salary or their hourly rate, that's your part of your cost of goods sold for sure. But then if you expect to have regular costs that vary with the number of classes you're teaching. Like, for example, if you teach an arts and crafts class, or if you teach a woodworking class as an example, then the materials you provide as part of that would also be part of your cost of goods sold. Yes, I would look at it that way. But this does bring up another question, which is, what if you're a sole operator? What if you're the only person in your business and you're delivering either consulting or you're delivering teaching, you're delivering some sort of service? How do you look at cost of goods sold? And you may say, how many hours am I putting into these classes I delivered this week? Because sometimes businesses don't pay themselves a salary. They just sort of keep what's left, and that's their take home, right? You know, I had a business, I charged a certain amount for teaching. I didn't pay myself a salary, but whatever the business brings in revenue minus my woodworking materials, for example, then that's what I get to keep. So how do you look at cost of goods sold in that case? Well, what I would do is I would say, well, how many hours did I deliver of teaching this month? And what is my kind of like assumed rate per hour, if you will, is one way to look at it. Like, what's a reasonable rate that a part-time teacher might charge for their time? And then you can say, this is what I charge for teaching. This is what my reasonable rate per hour is, and this is how many hours I deliver. This is my cost of labor, and this is my materials, the woodworking materials or whatever materials you're providing. This is my gross profit after those things. That's how I would look at it. Hopefully that helped. Good question.
Yeah, if there's no other questions, Cary, I want to thank you so much for coming out and doing this again. It was very informative.